Hello and welcome to this session. Today we're going to look at the cost of capital. I am your lecturer, Natalia Francois. The cost of capital. So the cost of capital, it represents the firm's cost of financing and is the minimum rate of return that a project must earn to increase a firm's value. So basically we're looking at what's the cost to finance a project. This cost will incur maybe raising money through debt, equity, right, or stocks, right, equity or stocks. Now, what's the cost of all of this? We know how much money we could get because we did the valuation, but what's the cost of doing such a project? Financial managers are ethically bound to only invest in projects that they expect to exceed the cost of capital. So yes, it's one thing to raise the money to purchase the item or invest in the project, I should say, invest in the project. But what's the cost of that investment, even though you raise the money? The cost of capital reflects the entirety of the firm's financing activities. So most firms attempt to maintain an optimal mix of debt and equity financing. So financing is how they're going to finance the project or the asset, either by debt, and we know debt relates to bonds, and equity relates to stock. So debt and equity. And we know there are two types of stock, preferred and common. If you missed that in the last session, you go back and you review it. Debt relates to bonds. Now, to capture all the relevant financing costs, assuming some desired mix of financing of maybe debt or equity, we need to look at the overall cost of capital rather than just the cost of a single source funding, rather than just the cost of what's the interest payments on the debt, what's the dividend payments on the stock. We need to know what's the total cost of all the capital or financing we use for a project. Here we have, a firm is currently faced with two investment opportunities. Assume the following. Investment A, cost is 100,000. That's the cost of the investment. The life is 20 years. An expected return of 7%. Least cost financing source available. Least cost of financing source available is debt or bonds, 6%. So the firm can borrow debt or issue bonds at a 6% rate, right, and invest in this investment for this cost, this lifespan over these years. Because the firm can earn 7% on the investment of the funds, but it's costing them 6%, the analyst recommends that the firm undertake this investment. So we look at the percentage. We don't look at just the fund and say, the cash flow. So the cost is 1,000 and the return is 7%. We need to also look at the cost. So in this session, we're focusing on the cost of financing the investment. Here we have investment B. The cost is same 100,000. The life of the investment is 20 years. The expected return from this investment is 12%. The cost of financing available is equity. In this case, for investment B, it's not debt, it's equity. Equity is stocks. It's 14%. That's the cost. In this instance, the analyst recommends that the firm reject the opportunity. Why? Because 14%, it is more than 12%, right? Financing cost is greater than the 12% expected return. So you pay more for the equity just to get the investment, but you wouldn't get the returns. What if instead the firm used the combined course financing? So assume a 50-50 mix, which means 50% of debt, bonds, 50% of equity, stocks, is targeted. The weighted average cost here is, so the weighted average cost 50-50, 50% by 6% debt, right? We know 6% was the return, the cost, the interest rate, and 14% again is the rate. So it's 50 by 6, 50 by 14. When you add them up, you should get 10%. With this average cost of financing, the first opportunity would have been rejected. Why? Because it's a 7% project. Investment A is a 7% return. While with the weighted cost of average, if they use both debt and equity, you only get back 10%. Now I know somebody will ask me, where did I get the 7%? 7% is the return on project A. However, the cost to fund the project or the investment is 10%. It would be rejected. The second one would have been accepted. Why? Because investment B, the return is 12%, and the cost, with the weighted average, a mix of debt and equity, it will be accepted, right? So we have those different options. Now, when you look at your balance sheet, these areas in the balance sheet tells you how the firm is funding its capital, the cost of its capital, how it's funding its investments. So its long-term liabilities, its long-term liabilities, which would be its debts or bonds, notes, long notes payable, equity, stockholders' equity, which are preferred stock and common stock, right? Common stock equity. Those three items we use debt and equity to fund capital. Now the pre-tax cost of debt, meaning the tax before the cost of debt, is the financing cost associated with new funds through long-term borrowing. Typically, the funds are raised through the sale of corporate bonds, right? So debt, again, is bonds, and the firm raises it through the sale of corporate bonds. The net proceeds are the funds actually received by the firm from the sale of the security. So when they sell the bonds, they receive money for it, and that's called the net proceeds. Flotation costs are the total cost of issuing and selling a security. Now there's a cost. If you remember in previous section, we talked about the firm selling or issuing the bonds. They don't go issuing the bonds or the stocks. They don't go directly to the bondholders, right? They always go through some intermediary. So these include underwriting costs, compensation earned by investment bankers for selling the security, and administrative costs. Issuers' expenses such as, the legal costs, accounting, and printing. Example, Duchess. We're looking at Duchess in this session. Duchess Corporation is a major hardware manufacturer contemplating selling 10 million worth of 20-year 9% coupon bonds with a par value of 1,000. So we know the par value 1,000. When I see a problem like this, I just like to write it out so I know what everything is, right? I know my coupon rate is 9%, or in dollars is 9% of 1,000 is $90. Because the current market, and I know, the period is 20 years. So I know I have everything, right? Because current market interest rates are greater than 9%, the firm must sell the bonds at 9.80, right? It's greater, the market interest rate is greater, so therefore this bond is selling at a discount, right? So we have the price of the bond price is 980. Flotation costs are 2% of 1,000 or $20. So my flotation cost is $20. The net proceeds to the firm for each bond is therefore 960. So out of each bond, if they sell one bond for 980, we minus the cost. As we said, the flotation cost, maybe it's underwriting, administrative, legal. Now the cost for the bond is now 960. Well, this is how much you will get for each bond, right? 960. And they're selling 10 million. So in total, the firm will raise 960 by 10 million. The before tax cost of the debt. So the before tax cost of the debt, right, that's RD, is simply the rate of return the firm must pay on the new borrowing. The before tax cost of debt can be calculated in any one of three ways. Using market quotation, using the market quotations. Here we observe the yield to maturity on the firm's existing bond or bonds of similar risks issued by other companies. Then we calculate the cost, find the before tax cost of the debt is bond, by calculating the YTM, and then approximate the cost. So the cash flow associated with the sale of Duchess Corporation bond issues are as follows. So in year 0, when they raised the money, they would have raised 960, right, per bond. And for the 20 years, they would have paid 90 million. And at year 20, they pay back the full, $98 per bond. And at the end of the 20 years, they pay back the bond at par value. So this is the price they get for a bond, 960. This is how much interest coupon. And then this is the par. Right? We can determine the cost of debt by finding the yield to maturity, which is the discount rate that equates to the present value of the bond outflow to the initial flow. So using our calculator, right, or Excel. If you use the online calculator, these are your values. So you're putting in PV, that's the present value the bond is selling for, 960. That'll be negative. Future value, that'll be positive. Future value will be negative because in this instance, this is the firm issuing it. So it's the reverse. Coupon payment, PMT is the online calculator. You'll have 90 and NP, the period is 20 years. Now you're going to solve for I, which is your yield to maturity, and it's supposed to come up around that, right? 9.45. Same thing with Excel. So here we have the yield to maturity of this bond, right? That's the cost for the bond. Approximating the cost now of the bond, that's the yield to maturity. Now we want to know what's the cost, overall cost of this bond. Approximating the cost, right? That's the next step. This is the formula. I interest rate or coupon rate plus 1,000 minus net proceeds from the sale of the bond over n, the number of period for the bond maturity, divided by the net proceeds of the bond plus 1,000 divided by 2. So you work the numerator first and then work the denominator and then we divide them. Let's see how they do this. Example. So we have the coupon rates. Remember the coupon rates for interest rate was $90. Formula says 1,000 plus the net proceeds, which was the $980 minus the $20, $960 divided by 20 years for the bond maturity date. Right, so we get $2 there. 1,000 minus 960 is equal to 40 divided by 20 equals to 2. So 90 plus 2 gives us 92. So we have the numerator. The denominator, the net proceeds of the bond, which is in 960 plus 1,000 divided by 2 gives us 980. So the total cost of issuing this bond is 9.38%. So this is how you find the cost of capital for a bond. Now, after the bond is issued, there are taxes to be paid. So the interest rate paid to bondholders are tax deductible for the firm, right? So the interest expense on debt reduces the firm's taxable income and therefore the firm's tax liability. The after-tax cost of debt can be found by multiplying the before-tax cost, RD, by 1 minus the tax rate. So let's see. Duchess has a 40% tax rate. So let's write the formula first. The formula is RD, required rate of return, is equal to RD times 1 minus the tax rate. So we have tax rate is 40%, and again I just like to write it so I don't have everything. Using the 945% before tax, which is the cost of debt, we find, using the calculator, we found that it would be 9.452% times 1 minus 40%. And here you get 5.6%. Now that's your return or your cost of debt after taxes. Right? So typically the cost of long-term debt for a given firm is less than the cost of preferred or common stock, partly because of the tax deductibility of interest. Well, we'll see it as we go on. So now we've calculated the cost of debt. Now they are saying it will be less than the cost of stock or equity. So the cost of this debt is 5.67. Keep this figure in mind. Let's look at the cost of preferred stock now. Preferred stock gives the preferred stockholder the right to receive their stated dividends before the firm can distribute any earnings to common stockholders. And we did preferred stock in the last session. Preferred stock dividends may be stated as a dollar amount. Sometimes preferred stock dividends are stated as annual percentages rate, which represent the percentage of the stock's par or face values that equals the annual dividend. So the cost of preferred stock, so we just calculate the cost of preferred of debt. The cost of preferred stock is the ratio of preferred stock dividend to the firm's net proceeds from the sale of the preferred stocks. So it simply divided the dividend by the proceeds to get the cost of preferred stock. Here we have again, so Duchess Corporation is contemplating the issuance of a 10% preferred stock that they expect to sell for $87 per share. So the cost of issuing and selling the stock is expected to be $5. The dividend, so we know the share or the stock price is $87. We know there's a 10% issuance. Return or dividend will be 87 by 10%. So our dividends will be $8.70. Net proceeds will be equal to, before we go to net proceeds, we have the cost of selling the stock of $5 per share. So we know net proceeds, how much they will gain from selling this stock. 87 minus 85, they're going to get $82 per share, right? 80 minus $5 flotation, sorry, $5 flotation give us $82 per share. So this is the cost. So the cost, I'm forgetting the next part. So the cost for issuing preferred stock is dividend over the net proceeds, which is the 8.7 divided by 82, gives you 10.67%. You realize it's more than the cost of debt. Then we go to the cost of common stock now. The cost of common stock is the return required on the stock by investors in the marketplace. Now there are two forms of common stock financing: retained earnings, this is the amounts we keep adding year after year from net profit, and there are also new issuance of common stock, where the firm issues new stock to get more financing. Now the cost of common stock equity is the rate at which investors discount the expected dividends of the firm to determine its value. So let's look at this. Under the constant growth model, we did it in last two sessions, we assume that the value of the share of stock, right, the value of the share of stock equals the present value of all the future dividends, assumed to grow at constant rate, right? That's at the constant rate. That is, they're expected to provide over an infinity time horizon. So we had to find the price of the stock first. And it's D1, which is the expected dividend, divided by the required return minus G, the growth rate, constant growth rate. Now, if you get a question that requires the stock not to grow at constant but at variable rate, you have to use the next formula, which is same thing, sorry, same constant, same growth model. Solving for RS results the following expression for the cost of common stock equity. So solving for the common stock equity, we have D1 over P, price of the stock, plus G. Right, so that's why we need to use the first formula to find the price of the stock if we're not given, because we need the price of the stock in this instance to find the cost of common equity. Duchess Corporation wishes to determine its cost of common stock equity. The market price of the stock of the common stock is $50 per share. So we know PO is $50. The firm expects to pay dividends of $4. We know D1 is 4 at the end of the year 2016. So we have dividends for this time, and 2016 is $4. The dividend paid on the outstanding stock over the past 6 years are shown as follows. So we calculate the annual rate of which dividends have grown, G, right? In previous sessions, you would have learned how to calculate the growth rate. So the growth rate here is approximately 5%. Substituting D1 and PO, so the formula was D1 over PO plus G. We have substituting $4 over the price of the stock, $50 plus the growth rate, we get 13%. Now, do you remember what's the cost of capital for preferred stock? The cost of preferred stock? The cost of preferred stock was 10.7 and the cost of debt was 5.67. So the cost of debt is cheaper than the cost of preferred stock and common stock. Oops. Under the capital asset pricing model, right, it describes the relationship, CAPM, remember that, describes the relationship between the required return and the non-diversifiable risk of the firm as measured by the beta coefficient. So remember this from the last 2 sessions. Risk-free rate plus beta plus the market rate minus the risk-free rate. Right, that's how we find the rate, the expected rate, taking into consideration the diversifiable risk. Now, Duchess Corporation now wishes to calculate its cost of common stock equity by using the CAPM model, right? The firm investment advisor and its own analysts indicate that the risk-free rate equals 7% and the firm's beta is 1.5 and the market rate is 11%. Substituting these values into CAPM, we have, so RS is equal to the risk-free rate plus beta times the market rate minus the risk-free rate. And here they substitute risk-free rate 7%, beta 1.5, market rate 11%, minus the risk-free rate, and we have 13%. So the cost of capital using the cost of common stock capital using CAPM is 13%. It's the same if you use the Gordon Growth Constant model. Now, just some notes that the CAPM, it differs from the constant growth valuation in that it directly considers the firm's risk, right, as reflected by the beta, in determining the required rate of return or cost of common stock equity. And the constant growth does not look at the risk, right? It just uses the market price. The constant growth valuation and CAPM techniques are finding the cost of common stock equity are theoretically equivalent, though in practice estimates from the two methods, they don't always agree. But in this case it agrees, but in normal cases they don't agree. Another difference is that when the constant growth valuation model is used to find the cost of common stock equity, it can easily be adjusted for the flotation cost. To find the cost of new common stock, the CAPM does not provide a simple adjustment mechanism because we just take the risk-free rates. We don't use the cost of the stock. The difficulty in adjusting for common stock equity calculated by using CAPM occurs because its common form, the model does not include the market price variable needed to make such an adjustment. The other way of using common stock is the cost of retained earnings. It's the same as the cost of an equivalent fully subscribed issue of additional common stock, which is equal to the cost of common stock equity. So it's the same thing. If you have common stock equity that have not been issued, it will be equivalent. Retained earnings is equal to that amount. Right? So the retained earnings is equal to the additional issue of common stock. The cost of retained earnings for Duchess was actually calculated in the preceding example. It is equal to the cost of common stock. Thus, the cost of capital is R equals 13%. So retained earnings, the preferred source of funding, right? So that's when the company make a profit. They will distribute some to the shareholders as dividends. Those are the amount that they keep back, right, from year after year. We will call that retained earnings, and that's what the company would use, to make their investment. They don't just keep the money there; it's for investment purposes, right? In U.S. countries and China and so forth, they depend mostly on that, right, and not bank loan as a source of funding. How about new issuance of common stock? That's another way the company can raise money, by issuing new shares. The cost of a new issue of common stock is the cost of common stock net of underpricing and associated flotation costs. So new shares are underpriced if the stock is sold at a price below its current market price. So the market price is $10. The shares are underpriced. They are sold at maybe $8. Subtract the market. We can use the constant growth valuation model expression for the cost of existing common stock, right? That's what we did as a starting point. Now, if we let N represents the net proceeds from the sale from the new common stock after subtracting underpricing and flotation costs, the cost of the new issue can be expressed as CMD1 divided by the net proceeds. Right, net proceeds will be after flotation and underpricing plus the growth rate. Now, the net proceeds from sale of new common stocks will be less than current market price. Therefore, the cost of new issuance will always be greater than the cost of existing issuance, which is equal to the cost of retained earnings. The cost of new common stock is normally greater than other long-term financing costs. Because think about it, you want a share on the market before. If you're bringing on new shares, you have to put it at a lower price, to attract new buyers. Duchess Corporation common stock is currently selling at $50 per share. To determine its cost of new common stock, right? So it's currently at 50. Duchess Corporation has estimated that an average new share should be sold at $47. We want to attract new buyers. The $3 per share underpricing is due to the competitive nature in the market. A second cost associated with new issue is flotation costs, which is $2.50 per share. That will be paid to issue or sell the new shares. The total underpricing plus flotation is $5.50. So that's the $3 plus $2.50, $5.50. So using the Gordon discount model to find the cost of capital, we have the dividends of $4 divided by the price of the stock. So the dividend divided by the price of the stock, $44.50. This $44.50 came from $47. So the PO is equal to the $47 minus $5.50 flotation costs. We get $44.50. So the PO plus the growth rate was 5%. So the cost of capital to issue new stock is costing them more. It's costing them 14%. Weighted average cost of capital. We're coming to the end. The weighted cost of capital. Cost of capital, you may have heard this term before, or maybe it's the first time, reflects the expected average future cost of capital over the long run. Found by weighting the cost of each specific type of capital. So each capital, the debt, the equity, the common stock, and the preferred stock, putting them together as a weighted average and finding the cost of each together. So this is the formula for finding the cost of capital, weighted cost of capital. We put in our weight to every type of capital. So W1 will represent long-term debt, which is the bond, and the required return. WP would represent the preferred stock. WS represents the common stock, right? And they all should add up to 1. So it comes like, the probability. And here we got the value for each one, right? So this one was 5 point something, 9 point something, and 13. Remember that one. 3 important points should be noted in this equation. For computation purposes, it's best to convert the weight into decimal form and leave the individual cost in percentage terms. The weight must be non-negative and sum to 1. Right? So these weights here will mean how much percentage of this you're going to use, how much percentage of debt, how much percentage of preferred, how much percentage of common stock. How much of it? It all should add up to 1, right? The firm's common stock equity is multiplied by either the cost of retained earnings or the cost of new common stock, which cost is used depending on whether the firm's common stock equity will be financed with retained earnings or common stock. Because we saw with retained earnings we got 13%, but with new stock we got 14%. So that's just some things to note. When you're doing this equation, you have to decide, or they have to decide, which source of financing they're using for the weighting. Can be both. Right. So in the earlier examples, here's what we found. The cost of debt, this is the bond. The cost to issue this debt, 5%. The cost to issue the preferred stock was 10.6. The cost to issue retained earnings was 13%. On new common stock was 14%. The company uses the following weights in calculating the weighting average. So they're going to take 40% of debt, 10% of preferred stock, and 50% of common stock. They all should add up to 100%, right? So this is the weight, and this is the cost of capital. Now with the weighted average formula, this is what we do. So we just put it in a table form. So here we have the weights, the long-term debt, 40%, preferred stock 10%, and common equity 50%. So when we say any percentage, let's say they're trying to raise $1,000. So it just means that 40% of this, which will be 400, 10% will be preferred stock, and 500, right, will make up the 1,000. That's what they mean, right? So it's a percentage of how much money they're trying to raise. So simplicity, I put 1,000, but it's usually large amounts, right? So the weight is the percentage of financing or source of capital. Now, what's the cost to finance long-term debt? 5.6. So the weight, you multiply the weight by the cost, we get 2.2. Preferred stock, it costing us, the weight is 10% of the project, and it costing us 10%. So when you're taking 10%, it's costing us 10%. So the weight cost is 1.1. Common equity, it's 13%. That's new issuance. No, sorry, of retained earnings, it's 13%. So we're taking 50% of the cost on, or we're raising 50% of the capital through common stock, and it's costing 6.5. To find the weighted average cost, we total it and we divide by 3. Right? No, we don't divide by 3, sorry, we just find the sum. So the weighted cost, because we found the average for each one, right? So we just find the sum. 5, 6, 7, 8, 6, 7, 8, 9. 9.8. So the weighted cost of capital, if we take all 3 items, this is the portfolio of debt financing. So let's put it in context. If the company is financing some big equipment for 20 million, it will cost them, if 40% was raised by debt, 10% was raised by preferred stock, and 50% was raised by common stock, it will cost them 9.8% together. Right? That's the weighted cost of capital, and most times this is the one that is used. Weighting scheme. So book value versus market value. So book value weights are weights that use accounting values to measure the portion of each type of capital in the firm's financial structure. So you see here we have 10, 40, 50. Sometimes there's a book value that is used. Market value weights are used to measure the proportion of each type of capital in the firm's financial structure. Historical versus target. Historical weights are either book or market value weights based on actual capital structure portions, or target weights are either book or market value based on desired capital structure. Proportions. Structure proportions. From a strictly theoretical point of view, the preferred weighting scheme is target market value. Right? That's the most one. That's the one that's mostly used. Now just put a little personal finance example onto it. Then this is the last slide. It says Chuck Solis currently has 3 loans outstanding. This might apply to you, or it can apply to someone, or maybe you can help someone. So pay attention. People always ask this question. They have 3 loans outstanding, all of which matures exactly 6 years and can be repaid without penalty anytime prior to maturity. The outstanding balances and annual interest rates on these loans are noted below. So it's telling us that he has 3 loans. 1, 2, 3. Loan 1 is 26, loan 2 is 9,000, loan 3 is 45,000. For each one, there are different interest rates. So maybe this one might be a credit card, this one might be a car loan, this one might be a furniture loan, right? So he has these 3 loans. All of them are up for maturity, or they're going to finish pay off in 6 years. That's what it's telling us. Now, Chuck found a lender. You know, you found somebody who tell you they want to amortize. Let's consolidate. Sorry, not amortize. Let's consolidate these loans. So he found a lender who would loan him $80,000 to consolidate all these loans for 6 years. Same 6 years, at an annual interest rate of 9.2%. So we're going to bundle the loan and put them into one loan at an interest rate of 9.2%. Have you heard about that? Consolidation? On the condition that the loan proceeds be useful to fully repay the 3 outstanding loans. So he must use the money to pay off the loans, which combined have an outstanding balance of 80,000, 26, the 9, and the 45. Chuck wishes to choose the least cost alternative. So is it better to just keep his 3 loans and pay them one by one till 6 years? Or can he consolidate them in one by borrowing the 80,000? Most persons, when they do this, they look at the premium and they tell you, well, yeah, look, the premium is less, so I'm going to go that way. But once you do finance, we look at the rates. So let's see what's the cost. The cost of financing this debt one time. Chuck calculates the weighted average cost of his current debt by weighting each debt, right? The weighted average cost of capital, annual interest rate by portions of 80,000. Total it represents, and then summing the three weights as follows. So the first debt, the weighted average 26 over 80, which is the total. That's the first one. The cost of capital is 9.6, right? We looked at that. The second debt is 9,000 over 80,000. So let's do it one time. So when we work out that, we get this. When we work out that, we get this. When we work out the third loan, we get this. And we multiply it by the interest rate for the debt, right? So the interest rate for the debt for debt 1 was 9.6, for debt 2 was 10.6, and for debt 3, 7.4. Average weighted cost, right? So here we have for debt 1, we sum in it, debt 2, debt 3, weighted average is 8.5%. Now, the person who offered him an interest rate. You realize? They offered him to consolidate this loan at an interest rate of 9.2%. Is he better off? No, he's worse off because he's paying 8.5% together. So he should do nothing. Given that the weighted average cost is 80,000 and the current debt is 8.5%, it's below the 9.2 cost of the new $80,000 loan. Chuck should do nothing and just continue to pay off his 3 loans as originally scheduled. Come to the end of this session. Thank you. See you in the next session.